You're listening to The Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koch, president and portfolio manager at Libertas Wealth Management Group at libertaswealth.com.
Happy Tuesday, everybody. This week starts the first week of a series of podcasts and articles that I produce and write each year in a series that I affectionately call Nerd-vember. Not exactly easy to say, but Nerd-vember is a time to get a little bit more into the weeds for those who want to learn a little bit more than just the basics when it comes to financial planning, retirement planning, estate planning, and investment management. Today, we're going to talk about stock market seasonality and the fact that there are two starkly different periods of time in the market when it comes to strength and performance. With that, we've got good news and good news. First, Halloween marked the end of the seasonally worst 6 months of the year, and November 1st marks the beginning of not only the seasonally best 6 months of the year, but also the midpoint of the best quarter of the year for the stock market as a whole. And I want to get into more of the details, but before we get started, as always, a few housekeeping items. First off, thank you so much for joining us. My hope is for you to learn a little bit more on each and every one of these episodes so that you become more successful, wealthier, happier, and above all, more educated than you were before you started listening or watching today. So come back often, subscribe. These episodes appear both on iTunes and YouTube, and you can also follow me on Twitter at Adam Koch and on Instagram at Financial Surgeon. Last but not least, all links, visuals, charts, and additional educational resources, which we will have some today, are always available on our website in the education section. In this case, it'll be under the podcasts, and we'll post those charts here. So let's go ahead and get started. But before I jump into the materials, I want to thank my good friend Tommy Dorsey, the founder of Dorsey Wright & Associates, as well as all my other old friends over at Dorsey Wright in Jay Gregnani, Paul Keaton, Ben Jones, Tammy DeRozier. They, along with Jeff Hirsch and Stock Traders Almanac, help put together all this great research every year, and really twice a year, and that I'm about to share with you. And so I want to make sure I recognize them for all their great work. But before I get started with the actual research and the numbers and the interesting stuff, which there is no shortage of today, as always, I've got a couple quotes. Today, two, normally just one quote. But the first quote is, if you don't like the weather in Ohio, here we are in the Midwest, so the quote goes, if you don't like the weather in Ohio, just wait a few minutes. And that's kind of how it was. I went to, took my family to the Browns game. Unfortunately, we lost to the Steelers, but I took them to the Browns game this past weekend, and I was saying it was the hottest cold game I've ever been to, between the 30-mile-an-hour constant lake wind in the breezeways and in the shade. You needed a coat, and in the sun, we took our coats off, and we were sitting with hats, baseball caps, and T-shirts, and we were still sweating while we sat there and watched this game. And honestly, I don't know if I have windburn, sunburn, or both, but it was an interesting time, and that's Ohio for you. But having to do with seasonality in the stock market, Don Connolly said this as well. This is another quote. So Don Connolly, a former national spokesperson for Putnam Investments, and for years and years now, he's been a consultant and a friend of mine. And Don said, think of investing in terms of gardening. Gardeners don't pull their plants up every day to check the roots. Doing so would destroy them. And neither should you obsessively check what's happening in the stock market. His point is to basically say that there is all this research, there is seasonality, there are times to be invested, times not to be invested, but at the end of the day, the best thing to do, unless, of course, you're managing your own portfolio, if you're doing your own money management, and by the way, I always say, if you're somebody who has the time and you love the stock market and you love researching the market, the economy, and you enjoy this stuff, then you absolutely can manage your own retirement portfolio. I'm not one of these people who says you need to hire a professional. There's just one caveat, and that is you have to have that passion or that interest, I guess I should say, and you have to have the time. So what we typically find is most people don't really have the passion or interest, first of all. And even if they do, the vast majority of people out there just don't have the time. Even if they want to take the time, they just can't find the time in their day to really pay attention to this stuff. So with that said, the reason Don Connolly made this quote that he did just recently, actually a couple weeks ago, I saw this, was because most people have a professional that's helping them with their investment management, financial planning, retirement planning, estate planning, and so on. And if you look at this stuff every single day and you worry about it, chances are you're probably going to destroy the roots of your retirement plan, which is the plan itself. I always say the number one reason retirement plans fail is because people fail to follow the plan. And the reason people fail to follow the plan is because of the short-term volatility in the stock market, and all the news and the things that freak us out have a tendency to make us want to throw our hands up, give up, and walk away because it's scary stuff. There's always something going on that is, I don't want to say designed, but could possibly get you scared enough to want to bail and pull the ripcord and abandon your retirement plan, and we don't want to do that. So without further ado, let's change gears here and let's get into some of the research. The first of which, and I will be posting this chart on our website at libertaswealth.com in the education section under podcasts. So if you want to come back to it later, if you're listening to this on iTunes, on the treadmill, or in your car, then you can come back and look at this chart later. But either way, I'm going to talk you through it. So the idea of seasonality, if any of you have ever heard the phrase, sell in May and go away, that whenever you hear sell in May and go away, that's people talking about seasonality, market seasonality. And what the seasonality studies say is that the months between May 1st and Halloween are the seasonally weak months of the year, whereas the months between November 1st and April 30th are the seasonally strong months of the year. Why is that? Well, we can go all the way back in history, and we can see that there was a time when prior to the 50s, we'll just say, farming was the best time of year because we were a farm-based economy. But since the 50s and the Industrial Revolution, what ended up happening is a lot of the production that took place actually took place during the months between November and April 30th, because of the Industrial Revolution and the production that takes place during those winter months, if you will. So between when you look at the seasonality returns in the stock market, you'll find that November and December happens to be the best quarter of the market for throughout the year when you look at averages. And then when you combine the first 3 months of the following year, it ends up being the best return or rate of return over the course of a 6-month period, whereas the months between May 1st, hence sell in May and go away, and Halloween end up being weaker months. In fact, September has a negative average return, and June is barely positive. So I'll give you the averages real quick there for those of you who are listening on iTunes. So October, the average rate of return for the market since the Industrial Revolution, we'll say 1957 in this case, is 1.44% per year. November, the average return is 2.15%, and the average rate of return for December is 1.35. When you scan into January, it's just over 1.5% per year. February is 0.72. And then March, the last month of the seasonally strong months of the year, is 1.3%. When you get into the weak months, so sell in May, go away, and April's over with, so 1.2% for April, and all of a sudden we're into the seasonally weak months. What we have here is May at a 1%, 1.06% rate of return. I mentioned earlier June has a 0.08% rate of return, so just barely positive. July has a rate of return on average of 0.69. August isn't bad at 1.17%, so nothing to be too upset about. But September is negative at negative 0.42%. So when you combine, May 1%, June basically even, July at 0.7 if I'm rounding, August at 1.17, September negative 0.42, and then October at 1.44, which again, just like August isn't horrible, obviously it's the best of those 6 months, it still ends up averaging out to where those negative, those seasonally weak months of the year between May 1st and Halloween are in fact the weakest months of the year on average when you look back to the 50s. Now, when we look at things in a different way, one thing I want to point out is that the month of November has a tendency to have the best returns, not only since 1950, but it has a tendency to have the best average rates of return since the past 20 years, the past 10 years, and in post-election years, which is the year we're living in right now. So last year was an election year. This is a post-election year. Next year is going to be a midterm year, and then the following year will be a pre-election year. So when you look at November, specifically, in those last 10 years, we've seen almost a 3% rate of return. In the last 20 years, it's closer to 2.5-ish. And then when you look at 1950, about 2% per year, and post-election years just a tad higher. So again, good things, or at least evidence suggesting good things are ahead. And then when we look at this, the next chart I want to show you, what it shows us is something pretty mind-blowing. And for those of you listening on iTunes, what you would be looking at here is a chart with the seasonally strong months of the year and staying in the market during the seasonally strong months, growing $10,000 to well over $1 million. So if you were invested from November 1st and you had your money 100% invested in the Dow, and you sold on May 1st every single year, or technically April 30th, and then you went to cash for the summer, basically went on vacation and sat in cash all summer, then your $10,000 back in 1950 would today be worth over $1 million. Now here's where things get weird. That same $10,000 invested in 1950 on May 1st and then sold on Halloween. In other words, you go on vacation during the seasonally strong months of the year and all your money's in cash during the seasonally strong months. The average rate of return for the Dow since 1950 puts your $10,000 in 2021, just this, we'll say 2 days ago, put your $10,000 at around $14,000. So you've basically made almost nothing. And I've got more specifics on that in here in a second. But there is a stark difference in performance when you compare the seasonally strong months of the year, which again, I'll repeat, November 1st through April 30th, as compared to the seasonally weak months of the year, which is May 1st. Again, remember, sell and May go away. It's May 1st through Halloween. Now, a couple other notes I wanted to share. I'll get all these from Dorsey Wright. 10,000 invested again during the seasonally strong months of the year since 1950 again would be worth more than $1.2 million today. That same $10,000 invested only during the seasonally weak months of the year since 1950 would be worth only $13,497 today. Pretty amazing. This change in the dates here since April 28th of 2000, so just looking back at the last couple decades, the Dow is up 185%. But if we isolate only the weak months of the year, so the seasonally weak months of the year, and we invested our money since April 28th of 2000, and only the seasonally weak months and went to cash during the seasonally strong months, our rate of return would only be 17% compared to 185, which is really interesting. And what this also equates to, by the way, is that since 1950, and really we can almost say the same since 2000, that almost all of the growth in the Dow has taken place during the seasonally strong months of the year. So super interesting stuff here. Next, a couple more fun facts. First of all, during the seasonally weak periods of the year since 1950, 27 of those 72 periods were down years. Now, this is compared to the seasonally strong periods of the year since 1950. There were only 15 occurrences where the market was down during this time of market strength. Now, there have only been 3 years when the seasonally strong periods have lost more than 10%. I'll say that one more time. So since 1950, there's only been 3 times when the seasonally strong months of the year lost more than 10%, or by definition went into a correction. And that was in 1969, 1973, and 2008 during the Great Recession, mortgage crisis, whatever you want to call it. This is contrasted with the weak periods of time. So the seasonally weak periods of the year have had 11 corrections of 10% or more during the time period between May 1st and Halloween. Now, since 1980, this also gets interesting. There have been 16 times since 1980 when the seasonally strong months of the year posted a double-digit positive return. And of those 16 times, 6 of those times, the return was higher than 20% in that 6-month period. Now, since 1950, following the times when the weak months were had produced double-digit losses. So, for instance, if the time between May 1st and Halloween was down more than 10%, we'll say double-digit losses, there was 11 times when this has happened. The following seasonally strong 6-month period lost more than 1% only one time, and that was 2008. So let me repeat that again. So since 1950, following times when the seasonally weak months produced double-digit losses, and there was 11 times when this happened, the seasonally strong 6-month period thereafter lost more than 1% only one time, and it was in 2008. And then on 4 other occasions, it actually printed a double-digit positive return, and that was in 1962, 66, 71, and 74. So even if the market is down, obviously, during the seasonally weak months, which is expected, there have been several times here, 4 times, when the market printed a double-digit positive return thereafter. And then lastly, just a fun statistic here, the past 6 months that we just went through into 2021, so this year marks the 6th consecutive positive rate of return for the Dow during the seasonally weak period of the year, which also ties the record for the longest streak since 1950, which took place in the 1950s. So I find that super interesting. Does that mean that it has to turn around? No, that doesn't mean that now we have to have a bad 6-month period of time. It's possible, right? Anything's possible. And that brings me to some things we need to consider here. So these are all great numbers. I always joke about the guy who drowned in a river that was an average of 4 feet deep. And that's the joke. There is no other, the joke is the punchline. So these are all averages, and that's all they are, is averages. And just because we're in the seasonally strong months doesn't mean the market has to go up between now and April 30th or May 1st. Research like this isn't meant to provide us certainties. Rather, it provides us with evidence, clues, hints, and what could lie ahead based on historical data. And when using technical analysis and relative strength and the things that we use here at our office to manage retirement portfolios, it's the utilization of probabilities, not certainties, but probabilities, that helps us make decisions and manage risk with our money. And I just put this quote on our dry erase board in the conference room, and it goes like this: "Prediction is extremely difficult, especially when it's about the future." So a Nobel laureate in physics, Niels Bohr, he said this a while back. So again, we always have to keep in mind that none of these things that we just talked about today have anything to do with certainties. Now, what about those of you who are worried about inflation, government debt, interest rates, and what direction they're headed? Well, a couple notes on that. First of all, if we have a falling dollar, if the U.S. dollar falls, international stocks will likely do better than U.S. stocks. However, even a falling dollar is probably going to be good for stocks in general, so that's not a horrible thing. An inflationary environment, if inflation continues to take hold, I know what we're seeing a lot on the news, economic news, is that this inflationary period we're going through is transitory because of the bottom in COVID, and that could be possible. We don't know. We're going to have to see what happens over the next several months. But if an inflationary environment takes hold, this also tends to lend itself to a positive commodity environment. So when I say positive commodity environment, what I mean is investing in commodities, hard assets, things like soft commodities, agricultural commodities, energy commodities, precious metals. So to break those down, soft commodities, things like think cotton, agricultural commodities, wheat, corn, soybeans, energy commodities like oil, natural gas, gasoline, precious metals, of course, things like gold, silver, non-ferrous metals even. So when inflation goes up, hard assets go up as well, or they tend to go up as well, I should say. And then as interest rates rise, if you're worried about interest rates long term, you should just be really careful with your bond portfolios, because when interest rates go up, bond prices or bond values go down. That's not a matter of speculation. That's just how it goes. If interest rates go down, bond prices go up. What we've been experiencing this past year and a half, 2 years, is a choppy interest rate environment, but right now anyway, the trend is up in rates. And as long as the trend is up in rates, the best place to be is either probably going to be in cash if you want to be super conservative, or you want to be short bonds, In our case, short 7 to 10 year treasuries, short 20-year treasuries. So in other words, when bonds go down, we make money when you short bonds. And then another thing to consider would be high yield bonds, which typically do well when the stock market's going up. We own convertible bonds, which convert to stock, which are still looking good, holding above their major trend lines, intermediate term trend lines. So when it comes to interest rates, the biggest things to worry about right now when it comes to your retirement portfolio are going to be the bond sleeve, or the bond portion of your portfolio. And then last but not least, I always say this, and I hate to sound like such a cliche or so repetitive, broken record, pick your cliche. If you don't have a financial plan, retirement plan, you need one. And you need to stick to that plan, whether that's, whether you're retired, whether you're planning on retiring soon, or if you're in your 40s and you've got years with kids in college or about to go to college, and years ahead of that before you quit working. In either case, retirees need an income plan, retirement income plan. Make sure they never run out of money in retirement. Don't want to spend your golden years at the golden arches. Don't want to go back to work. Pre-retirees want to make sure that when they quit, they can quit conservatively and never run out of money in retirement. And then people who are younger need to make sure that all of their items that they need to be taken care of early on, things like their 401ks, college, setting themselves up for a successful retirement, that those things are all taken care of well in advance, so you can worry less. It doesn't mean it's going to be a stress-free journey, but the goal is to keep the stress levels as low as humanly possible, and we do that by making sure we have a plan, that we stick to that plan, and we babysit it over time. All right. So that is all we have today. Be sure to share this episode with your friends and family if you think they would benefit, and if you'd like to discuss your personal financial situation better, remember, you never have to be a client to ask a question. So if you'd like to set up an introduction call, email us at info@libertaswealth.com or head over to our contact page at libertaswealth.com, and be the first to watch and listen to these episodes by subscribing both on iTunes and YouTube. And don't forget, if you head over to libertaswealth.com, you can sign up to get these updates and notifications, but also all of our other screencasts, videos, articles delivered directly to your email inbox whenever we release them and send them out. Feel free to follow us on Facebook at facebook.com/libertaswealth. Again, I'm also on Twitter at Adam Koch, as well as Instagram at Financial Surgeon. And as I always say, there's thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koch. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.